couple things. I'm going to give you, just as you mentioned, just an update on where we are with respect to the economic outlook right now. A couple things to focus on. The trade war, obviously, post-election policy changes, and then we can drill into stuff like inflation and what that means for things like interest rates and real estate and things like that across the financial market. First disclosure that I've been giving, and you probably heard this a couple months ago when we got into this trade war, is that it's 9:04 a.m., Wednesday, May 28th. That's when this forecast is dated. We could very well leave this room and have things looking different. It's actually happened to me before. We could obviously have things looking different next week or a couple months down the road. Okay, that's kind of the nature of the economic environment that we're in right now. So, quick sense of where we are right now. So when you're an economist, you're sitting there on the desk, you're looking at the data come in, and right now we see a lot of evidence that you're having this so-called soft impact of this trade war so far, right? Surveys of consumer confidence, way down. Surveys of business confidence, uncertainty is way up. We know that something is kind of coming down the pipeline at us. Everybody gets kind of stressed out and freaked out about it. They tend to hold back investment, they hold back hiring. What we haven't actually seen yet is it filtered through into the real economy. So we haven't seen job loss, we haven't seen the economy contract, but we're kind of at this risky pivot point now where if this trade war kind of progresses and doesn't, pivot more positively, we could ultimately see the economy roll over. Not quite there yet, but that's what we're looking at coming down the pipeline the next 2 or 3 quarters. And then just to give you
in 1930,
give you a sense of, is this trade war going to work? We can ask the professor. You've seen this before.
In 1930, the Republican-controlled House of Representatives, in an effort to alleviate the effects of the, anyone? The Great Depression, passed the, anyone? The tariff bill, the Hawley-Smoot Tariff Act, which, anyone raised or lowered? Raised tariffs in an effort to collect more revenue for the federal government. Did it work? Anyone? Anyone know the effects? It did not work, and the United States sank deeper into the Great Depression.
Okay, so it did not work. Frankly, this whole economic policy makes no fundamental sense, okay? The US economy is not an economy that should be assembling iPhones by hand and stitching textiles, okay? There's not a whole lot of value added in that. This is a developed economy that should be producing much more value added. Give you some context here. So, a couple of things he brought up. From a historical perspective, if you go back to like the 1920s, US tariffs were cranked up to almost 20% on a weighted average basis. That was kind of the eve of the Great Depression. That increase in trade tariff policy actually exacerbated and accelerated the downturn during that period. Go back to mid-May, the situation we were in when we saw big increases in tariffs across China, Asia, most of Europe. That weighted average US tariff got up to like 25%. So the market was freaking out because this is really, really bad, challenging economic policy. Since May 12th, quote unquote Liberation Day, they want to call it. I don't want to call it that, but we've actually seen US administration realize, okay, this is probably not going to give us the outcome that we want. There was a lot of pushback across industry, and they've actually started to scale those tariffs back down. So as we sit right now, we're looking at still about 14, 15% tariff on US imports versus where we were coming into the year. Obviously, that's a negative outcome, but we've walked back from the real brink of something that looked a lot more terrible. And my sense is that as we go forward, and again, this is really hard to predict something when you're trying to guess what an administration is going to do that's operating in an environment that doesn't really seem like it's driven by economic fundamentals, right? But my sense is that on a case-by-case, on a country-by-country basis, these tariffs are going to get kind of stepped back down, and we'll probably end up somewhere around 7 to 10%. That's not a good outcome by any means, but it's probably getting into the range of what's manageable, whether it's the producer outside America swallowing some of it, it's the business in the US maybe cutting margins a little bit, and then the vast majority of it probably just gets passed on to the US consumer, and you get a little bump in inflation. I'll get back to that in a minute. The other takeaway here is on the right side. So those red bars are where tariffs are now on various countries. The gray bars are what's still pending coming down the pipeline over the next 30 to 90 days. And again, I'm assuming some of that's going to get walked back. But look where Canada sits in here. We came into the year with a tariff of maybe like 1.5%. And right now, on a weighted basis, it's about 4%. So Canada, Mexico, kind of under the cover of USMCA, is getting off pretty clean right now. There are areas, obviously like steel and aluminum and parts of the auto sector that are under a lot more duress. But on a global basis, the sense here is that USMCA comes up for renegotiation in 2026. New administration here in Canada, we can probably crank out a deal, maybe speed up a USMCA renegotiation and kind of stay under the cover with a much smaller tariff impact. Fundamentally, what does a trade war do? I guess this is the big question that we were scrambling with coming into the year. That's just a quick picture of what our forecast was, the green lines at the start of 2025 and where we are now for a couple different things. The real fundamental challenge in a trade war, not to go all economics nerd, but it's a negative supply shock, right? So what that means basically is it's negative for economic growth, and at the same time it actually pushes up inflation. So it's a really bad combination, and again, hence why markets have stressed out about this. So we do expect growth to kind of bounce around zero for the next few quarters. We've cut growth this year by probably a full percentage point, and the reality is we're a small economy. We trade extensively with a country that doesn't want to trade as much anymore. That's the reality that we're dealing with. For the Bank of Canada, this gets pretty complicated. And I'll get to the rate outlook in more detail later on, but the complication for the bank is ordinarily, say you go into a recession or any kind of negative economic shock, the response is pretty straightforward, right? Cut interest rates. Can cut interest rates quickly, can cut them aggressively. Well, if you're an inflation targeting central bank, and now you're hit with a shock where inflation risk is actually rising, what are you going to do? They're going to be pretty careful not to cut rates too quickly because they don't want to keep that wheel of inflation going, so to speak. So relative to where we were at the start of the year, we're forecasters, so we make a judgment call on this. And then our judgment call here is that if this actually continues to play out, the economic impact is going to be bigger than the inflation impact. Bank of Canada doesn't want to tell you this right now, but they probably will cut rates further. So we have about 75 basis points of extra easing in there from the Bank of Canada in this environment. And then for the Canadian dollar is a funny one because the market's pretty smart, right? So it's almost a case of sell the rumor and buy the news. And the Canadian dollar was weakening well ahead of this kind of the peak escalation of the trade war. And the minute we got to those peak tariffs, the news started to get incrementally, I don't want to say better, but less bad. The Canadian dollar has actually rallied off that. So we've probably seen the lows for the currency unless we get a complete U-turn from the administration. The other aspect of this is, okay, we can say what's the Canadian economic impact, but it starts to look a lot different when you drill down into the different regions of Canada. Every province produces a lot of different stuff, so the impact is not uniform. That's just a picture of export exposure to the US by province as a share of each economy. Blue bars are non-energy, green bars are energy. I break those out because energy is an interesting one where the US can go ahead and slap a 10% tariff on Canadian oil, but what are they going to do? There's not a whole lot of alternatives in the short run, right? So heavy crude flowing into the Midwest refinery, you're not going to find an alternative source for that in the short run. What's going to happen? The refining margin swallows a little bit. Most likely the US consumer pays most of that through higher oil prices. So not a big impact there. So look at like Alberta, 35% of that economy is US exports, but the economic impact there is probably going to be not much at all because most of that's oil. Get into Ontario, Quebec, where it's autos, steel, aluminum, manufacturing. That's where the real target is, not only because some of those tariffs are higher, but look at like the auto sector. It's very deeply integrated, right, between Ontario and the US. And the Trump administration pretty much has said clearly that they want cars produced south of the border. So the concern here is that actually has a bigger short-term economic impact, but longer term, we actually do start to crowd out some of that auto production as that supply chain gets rerouted to the US. So bigger economic impact in central Canada if this plays out. And then what we tend to see then is, okay, well, start of the year, we go out and revise down our Canadian economic outlook. Let's call it a full percentage point. In Alberta, we didn't really change much at all. Saskatchewan, prairies, not much at all. Ontario, Quebec, we're probably cutting a full 1.5 percentage points off of growth here. So still growing, but pretty clearly a tougher environment in this part of the country. And what's interesting here too is that for the last couple of years, so Canada's a funny economy, right? We always talk about the Canadian economy, but it's really a bunch of different provincial economies that behave very differently. You'll have periods where the oil producers are growing like 4 or 5%, totally off the rails, and Ontario might be struggling. And then vice versa, go through like 2014, 2015, oil prices collapsed. Alberta was in recession. Ontario, Quebec were actually benefiting from lower oil prices, right? The last couple of years was really different. Everything was very, very uniform. And just as one example, like the difference in jobless rates across the country has never been narrower. So what this actually starts to do now is it threatens this kind of wedge in economic activity across Canada again, where you're going to have regions that are not impacted by the trade war very much continue to grow. If this plays out, we probably still have Ontario, Quebec struggling a little bit. So it drives a big wedge in economic growth across Canada. And that's a big change from what we've seen the last couple of years. Okay, so that's kind of a big picture view on this whole trade war situation. If there are questions, of course, we can jump back to any of this later on. But that hopefully gives you some context on how this all works. Next thing I want to shift to is into Canada a little bit. So again, full disclosure here, not in the business of making flagrant political statements. Those are the results up on the board. You might hate it, you might love it, but that's where we are. First thing I'll say here is that, so again, we're forecasters, we're looking at platforms, we're saying what are the odds that this Liberal election platform gets pushed through, and we think we have pretty good odds of a lot of this policy getting pushed through. We think it's a very strong minority government. 169 seats is not quite there. 172 is a majority territory. Two things. One is that seat count is very strong, right? So we're 3 seats shy of majority territory. Conceivably should be pretty easy to grab a couple votes on policy or to even have a couple MPs just even cross the aisle at some point, which would put them in majority territory. The other thing is look at the opposition parties. The NDP got decimated. They have no leader, they have no money. They're not going back to an election. The Bloc got hammered pretty hard in Quebec. They don't want to go back into an election. So there seems like it's going to be pretty easy to grab a couple of votes of support here. The other thing, and maybe even more importantly, is that there's a lot of overlap in terms of priorities between the Liberals, Conservatives, NDP, and the Bloc, right? And we all watched the election campaign. The funny thing that happened was when Carney got nominated, the Liberal Party pivoted all the way to the center, took pretty much all of the Conservative platform, save for maybe pipelines, which they don't want, but picked up on the vast majority of the rest of it. So it's going to be pretty hard for these other parties to actually come in now and reject any kind of Liberal throne speech or Liberal budget. So a couple major policy priorities on the board and what it means. First thing is we're going to get some tax relief finally, which is great, and that's again a priority they stole off the Conservative platform. Budget or no budget, it looks like we're going to see that bottom tax bracket cut by a percentage point on July 1st. Potentially some support for autos or other industries that get hit hard by this trade war if it continues to play out. And probably the biggest thing I would say here is infrastructure spending. So, I mean, love or hate the Liberals of the past, this flavor of the Liberals seems to be a little bit more pro-growth than the one that we've kind of dealt with for the last 8 or 10 years. And there are probably good like $8 to $10 billion worth of infrastructure spending coming down the pipeline over the next 4 or 5 years. And that's stuff like roads, rail, port infrastructure, trade infrastructure, all that type of stuff. And from a long-term economic perspective, even from a short-term perspective, given that it drives construction activity, not a bad policy plank to run on with especially productivity kind of struggling in Canada. On the housing front, big thing there is they want to, and this is where I kind of get skeptical, is have the government kind of put its hand right in the housing cookie jar by literally building houses. Call me skeptical on that. The government doesn't have a good track record of building things efficiently or building things in the right numbers. I don't like that at all, to be honest. Other areas like cutting the GST on new houses, fine. Anything that incents municipalities to kind of speed up the response with which we can build housing, right? Cutting down red tape or speeding up approval processes, that type of stuff, it's going to help. It's not going to get more homes built, right? Home builders are going to build to market conditions, but if the response gets faster, call that a win. And then on other things like immigration, I'll get back to that because that's a major story. And then on the deficit. So the deficit in that platform was running at about $65 billion. It's a chunk. It's 1.5%, 2% of GDP. Two things on this. One is I've spent a lot of time looking at federal and provincial budgets over the years. And when you do that, you get pretty good at figuring out what the tricks are. And in that Liberal platform, the tricks really weren't that good. It was, coming out and saying, okay, look, we're in a trade war. We're going to bank $20 billion worth of retaliatory tariff revenue, put that on the books, but we're not going to actually account for any of the negative economic impact of the trade war. So we're going to take the revenues, but we're not going to account for any of the costs. Okay, it's not much of a trick. What it means is that $65 billion is probably going to 75 or 80, unless the economic environment runs a little bit better than we think, and some of that support spending can kind of get scaled back, and I think that's ultimately what's going to happen. They might hit those numbers, but they're going to do that with the economy running a little bit better, and some of that support spending scaled back a little bit. Tax cuts are coming, infrastructure spending coming. That's all fine. That's coming down the pipe. So that's where we are there. Add it all up, and I mentioned kind of pro-growth policy. When you're cutting taxes, you're running an infrastructure spending program. That's directly going to benefit the economy. Add up the numbers, and you're probably adding about 0.5 percentage point to economic growth. So it gets kind of interesting because you have the trade war cutting back, let's call it a percentage point. You have fiscal stimulus adding 0.5 percentage point. And then you have this whole Buy Canada movement, which is kind of interesting, adding, by our estimate, probably another 2-3 of a percentage point. So there's a big mix in terms of where economic growth is coming from, but we have pretty good firepower here to counter it. And to that point, if you're stressed out about a $65 billion deficit in Canada, let's call it 1.5% of the economy, the US right now is running at $2 trillion. It's like 5% of the economy. And that's before this big, beautiful blow out the deficit bill, whatever they want to call it, filters through and adds another $1 trillion to the deficit. So at the top of the economic cycle, when the economy is strong, they're running a deficit that's 5-6% of GDP. That's the crazy talk, okay? It's not this. As much of a fiscal hawk as I am, and I don't love this, on an apples to apples basis or in comparison with the US, we're in a pretty good spot still. And in fact, if you look at what the market is saying right now, they're looking at the US and they're not freaking out yet, but they're looking at the US and saying, careful guys, 30-year treasury yields haven't been this high since like 2008. The US caught another downgrade last week. We're not at the point of freaking out yet like we did against the UK last year, but watch yourselves, we're pretty close. Okay, so that's from a fiscal perspective, the risk is in the US, it's not here in Canada. Okay, so kind of leaves us with an economy that's next couple quarters, we're not calling it a recession, but we're at risk of kind of grinding along with not a whole lot of growth. And then by 2026, presumably the worst case gets priced out and we start to grow again. For the US, pretty similar situation. We were, the real unfortunate thing in all of this is that coming into 2025, the economy was humming pretty well, right? The US was growing almost 3%. Canada, we had a pretty great contrarian story on. A lot of people didn't like the Canadian economy or the Canadian market. We actually did. We saw stuff like interest rates coming down quickly, inflation settling down, real wages accelerating, consumer spending coming back, housing firming up, and then we went and just threw the trade war on top of it, unfortunately. So that kind of leaves us again with a couple quarters of risk in Canada, a couple quarters of sub 2% growth in the US, and that's a pretty big downshift from where we were. So that's the big picture. Again, any questions on that stuff we can jump back to. Couple areas we can drill into a little bit more detail. The labor market, that immigration program that I mentioned, huge economic story. And then we can look at stuff like inflation and what that means for rates and housing. Okay, just so you know where we're going. So job market has softened quite a bit in Canada already. I mean, we're well off the pandemic period where we were struggling for workers across a number of sectors. Vacancies are down. The unemployment rate's up 1.5 percentage points. We do kind of see a little bit further back up in the unemployment rate when you have an economy that's not really growing for a couple quarters, which is the risk through the rest of this year. That's going to push that unemployment rate up probably around 7.5%. It's not a nasty recession or anything like that, but that's more or less the direction of movement. And again, just going back to that regional story, is Alberta going to move a lot? No. Is Saskatchewan going to move a lot? No. But what are you seeing in Ontario? You're already kind of seeing some auto production shut down. You're seeing manufacturing kind of investment hiring held back. So that's where we see a bigger impact. Can we push 8% unemployment, 8.5% in Ontario? Probably. It's not a financial crisis. It's not pandemic level, but that's more or less where the risk is. Funny thing is, when you look at the fact that the job market is softening a little bit, the flip side of that is we actually still see pretty strong wage growth. And so wages are a funny beast from an economic perspective because they respond pretty slowly, and a lot of times they reflect economic conditions that were in place over the last like 3, 4, 5 years, right? So think of somebody that put a contract in place in like 2019, 2020, when there was no inflation for a decade. Maybe that wage growth was like 2% or something, right? Well, in the interim, we've had inflation run at 4, 6, 8%. We come to renewal, and these guys are like, hey, you got to pay us back now. Okay, and then, so here's one anecdote I have on this. So I have 3 kids, and I do, any father, like pay them to do stuff around the house, clean the truck, cut the grass, all that type of stuff, right? And they come to me a couple months ago and they say, Dad, you got to pay us more. And I'm like, get lost, I'm not paying you more, right? That type of thing. They say, no, Dad, inflation's been 8%. The real value of what you pay us is falling. And I'm like, what are you talking about? And they say, no, Tim Hortons cards, this year they're $3. Last year they were $2. So we can't buy as many, right? I'm thinking, well, this is pretty good. I have to reward you for this. So I did pay them more. But there are 2 big lessons. The first one is don't leave these slide decks lying around your kitchen, right? Because they're going to find them. They're going to use them against you. But the more important thing is that like the psychology of this has filtered all the way down to like the middle school level, right? And so when the kids are talking about inflation and talking about getting paid more, you know it's permeated well across the economy. So you puts us in this weird spot where the economy is slowing, the labor market is slackening off, but because of 4 or 5 years of well above target inflation, we still have to pay that back. And that's kind of good and bad news. It's good news because real wages are actually rising faster than inflation again. So from the consumer perspective, great. From the perspective of us worrying about mortgage renewals, great, that helps. But from the Bank of Canada's perspective, and I'll get back to this in a minute, it kind of complicates things a little bit because that adds to that underlying inflation risk. Okay, so keep that in mind. I'll get back to the rate forecast in a few minutes. The other aspect of this that I would spend a few minutes on is the immigration program. So I mentioned this along with the Liberal platform. This actually kicked in before the election. But this kind of coming into 2025 was probably the biggest economic story in Canada until the trade war took over. And so for some context here, I'll give you a little background. So that's just a picture of population growth in Canada going back 10 years or so. It's in raw numbers. So 2024 would have been about 1.3 million people. It's 3.5%. How do I describe it? It's completely off the charts. Okay, massive population growth. The breakdown of where those people have come from is important. So the green bars are permanent immigration. That is immigration as like you and I would usually think about it, right? Somebody coming in as a permanent resident to work, maybe a skilled labor, maybe bringing family over, that type of stuff. Historically, Ottawa has had very defined targets on this. They publish them every November, and right now it's 350 to 400,000 people per year. So that's well telegraphed, well managed. The orange bars are births, so Canada doesn't have a whole lot of babies anymore. Again, I've got the 3, I'm doing my part, but I get it, like affordability sucks, women are more educated, they're taking higher paying jobs, having babies later, which means you have few of them, okay? It's not a Canada story, it's a developed world phenomenon. And again, kind of speaks to the fact that we actually do need that permanent immigration to fill the supply of skilled labor going forward. The blue bars are non-permanent residents. So it's temporary foreign workers and international students. Historically, we've always leaned on temporary workers to fill gaps in the labor market. You probably see this in your industry too. If it's seasonal work or if it's, aspects of like construction work where you just can't find enough labor domestically, we've leaned on temporary foreign workers to fill some of those gaps. But that's not what's happened in the last 3 years. So the last 3 years has been just an explosion of international students. And it's gone from like 40 or 50,000 per year to 800,000 per year. Off the charts. So here's the thing, and this is not driven by fundamentals. This is effectively a couple universities and international students using the system as a pathway to permanent residency, okay? So through this period, federal government, provincial governments were out there saying, we have to build more, we have to build more, we have to build more. And there was one economics team raised their hand and said, you guys have a demand problem, you don't have a supply problem. You can never build enough housing to meet an overnight increase in immigration of like almost 1 million people. And then at some point, the federal government started to listen and realize, you know what, this is actually a demand problem. That blue bar NPR section of the immigration program was completely unchecked and unregulated. And so what we're gonna actually do now is put a cap on this. So we're gonna put a cap on the number of non-permanent residents flowing in. It's about 7.5% of the population now. We're gonna get that down to 5%. What it actually means is over the next 2 or 3 years, we need to see an outflow of about 400,000 non-permanent residents per year. And that leaves us going from 3.5% population growth to about 0 for a couple years. And then we settle back into 1%, which is, from a long run perspective, about what we can actually match on the supply side, and it's about what we need to fill retiring baby boomers and stuff like that out the back end of the labor force. So this isn't like an anti-immigration thing or anything like that. This is just a simple arithmetic of setting levels that we actually need from a demographic perspective and that we can actually account for and match on the supply side. And there are a lot of like spillovers of this. It's funny, like you kind of get this question all the time. Well, we need the inflows to support the job market when we've had shortages of things like skilled labor, trades, electricians, plumbers, and stuff like that. But there's a catch-22 here, right? If you're bringing in 800,000 people that don't have those skills, which in most cases they didn't, what you're actually doing is adding to the demand side, because the minute somebody comes in, they need a place to live, they need a doctor, they need healthcare service. But if those people coming in don't have those skills to fill that part of the labor force, you actually make the gap even worse. And so that's effectively what we're correcting now, something that went off the rails a little bit. The impact of that, of course, was just a lot of inflation in things like services and rent. So it's funny too, talking about this supply and demand problem, policymakers were chasing rents, trying to get rents under control for years, building more. The minute they put a cap on non-permanent residents, almost like to the month, to the minute that cap went in, rents peaked and started to fall off. And now across a lot of the major cities, Toronto's, the Vancouvers, rents are actually falling. So there you go. So big economic change there. Where does that leave us on the inflation front? So from a US perspective first, give you the bad news first. From a US perspective, if you're gonna go and throw a 125% tariff on China, where you source the vast majority of your consumer goods, you're gonna get inflation from that, right? Most of that passes through. So we're looking at about 2.5% inflation in the US right now. We're probably gonna get another half to full percentage point boost if these tariffs actually hold in place. Canada's an interesting story because we're actually in a pretty good spot. So we're running at 1.7% inflation right now. Part of that is because the carbon tax just rolled off at the consumer level, right? So that cut 7/10. Put that back on, you're still running at about 2.5%. And probably more importantly, from a Bank of Canada perspective here, is that core inflation, and they do this to kind of confuse everybody. They publish like 5 or 6 different measures of inflation, but the ones that they really focus on are not the measures that are going to bounce around when carbon taxes change. They're the underlying measures of core inflation. And those are still kind of running around 2.5% to 3% in Canada right now. So I'm not going to go through everything that drove inflation the last couple of years when we had that episode of 6-8%. I think that's pretty well documented right now. But where we're still kind of stuck is on what we've been talking about, right? It's the trade war adds risk to the upside for inflation in both Canada and the US. It's wages, which we talked about, and that's psychology. When the kids are talking about inflation, it's still out there in the business community. It's still out there at the consumer and household level. And expectations of inflation drive further inflation themselves. So that's what the central bank's really worried about right now. It's the psychology and potential impact of the trade war. So what does that mean then for the Bank of Canada? That's really the question here. And for the Federal Reserve. So the Federal Reserve still has interest rates up there 4.25%, 4.5%. That's very restrictive. They want to cut interest rates, but they're looking at 125% tariffs on China and know that this is going to have an inflation impulse. They don't know what it's going to be, but they know they have to be a little bit careful cutting rates too fast, too soon. So they want to cut rates, but they're on hold for early part of the summer, and we suspect that eventually, again, the negative impact of the trade war is going to ultimately win out, and the Fed will cut rates 3 times through the rest of the year, 75 basis points. I think we have July, September, December on the books right now. For the Bank of Canada, I mentioned things are changing quickly, so we have 75 basis points of easing in our forecast. Again, it would be June, September, December. I'm going to go ahead and say that the Bank of Canada is not cutting rates next week, so we're going to actually probably pull that first 25 basis point rate cut out of our forecast. We're probably going to get 50 beeps of further rate cuts from the bank. So let's call it like 225 by the end of the year. So the first big takeaway is that there's probably downward pressure on interest rates at the Bank of Canada and the Fed, but they're going to be pretty careful in doing so. And from the bank's perspective, we don't have a whole lot further to go, probably about 50 basis points. The second big takeaway is if you look at where 10-year yields are on the right side, and if you look at where rates are going to settle in here for the Bank of Canada, we're pretty well at neutral now. And neutral now is a lot higher than it's been in the past, right? So 2010, 2011, right through the pandemic, policy rates were averaging like 1%. That's an era that doesn't exist anymore. Okay, so if you're sitting there on a mortgage hoping to go back to 1.5% to renew or to buy property, you're going to be disappointed. We're not going there. We might go there through a recession or something like that, but the neutral level for interest rates is now pretty much where we are today. So from a Bank of Canada policy perspective, that's where we are. Walk into the bank and look at what GIC rates are today. That's pretty normal. Walk into the bank and say, what's my mortgage cost? 3.75, 4, 4.25, depending on your term. That's pretty normal, and that's probably what you want to budget for going forward. Not necessarily the next like 6, 12 months, but the next 2, 4, 6 years. Okay, and there's a lot of fundamentals behind that call, and that's not new. That's something we've been arguing for a long time. Some of it's demographic, some of it's global. You're pulling supply chains into North America, that's inflationary. You're shifting to clean energy, that's inflationary. There are technical factors. The Federal Reserve is out there selling treasuries now, not buying through quantitative easing as they were post-financial crisis, upward pressure on yields. We talked about the budget situation in the US. There's a risk premium building into treasuries now. If you're going to run $2 or $3 trillion deficits, you got to pay us more for that because that's a little bit risky. So that argues for higher yields too. Okay, so on the rate forecast, 2 big takeaways. A little bit lower for rates, but carefully. And the neutral level that you want to plan for going forward is about where we are today. It's not 200 basis points lower. Questions on that, of course, we can come back to. A couple minutes on housing. I don't want to take up all of your time here. A couple minutes on housing, and then we can wrap it up. So from a Canadian perspective, the short story is pretty simple. We're just not seeing a whole lot of anything. Sales are flat, prices are flat, construction activity is probably backing off a little bit. But from an overall national perspective, we don't see too much going on. Big difference is when you start to look across the different markets and across the different segments. So location, 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 right? That's just a picture of where prices are relative to the 2022 highs. There are markets out there that are still performing pretty well. Calgary's, the Montreal's, the Atlantic Canada's, not a whole lot's happening. Things are great. Prices are at record highs, markets are balanced, no problem. Demographics are strong. Vancouver's pretty soggy. When you get into Ontario, the GTA and Southern Ontario, that's where things start to look quite a bit tougher. And I don't know, you probably see this out there on the ground. I certainly see it out there on the ground when I talk to people in the real estate and the home building business. So the location matters a lot, and we are in the tougher spot here. Just because things got too frothy too fast in 2021 and 2022, and we're paying back for that now. The segment also matters. So single attached housing in Canada, it's funny, especially in the GTA in Ontario. We've been building like crazy for the last 15 years. We've been building no single attached houses. So think about me. So I'm leading edge millennial. I've got those 3 kids. What do you do when you have your second kid? You go look for a backyard or a street. Problem is they haven't made those for about 15 years. So you have the peak of the millennial right now that's about 32, 33 years old. All of them are looking for backyards, and we just haven't made them. So single attached housing is pretty well bid still. So while you walk around the suburbs of Toronto and you try and find a detached lot, you're $1.5, $2 million for basically a bare lot, right? That's not necessarily changing the next couple years. What is changing is what have we been building? We've been building a ton of small one-bedroom condos. What happened in 2022? Investors were buying up pre-construction condos like they were going out of style. So think about how this trade is playing out right now. You went in there in 2021 as an investor, you bought 1 or 2 or 3 of these pre-construction condos with the intention of just flipping the contract. Well, that market started to dry up when the Bank of Canada raised rates and all the froth came out of the market. So that market is gone. What's your next step? Well, I'll just take it to completion and I'll sell it on the resale market when it's done. Well, prices are off 20, 25%. I can't do that without taking a big equity loss, right? What's your next chance? Your next choice? Well, the rental market's strong. I'll just flip it on the rental market. Well, we've put hard population caps in. Rents have started to fall. There's about 100,000 rental units under construction or condo units coming down the pipeline in Toronto. Supply is rising right when demand is backing off. And from a cash flow perspective, what might have made sense when you bought that contract at 1.5% borrowing costs doesn't work at 4% borrowing costs. So I can just swallow the negative cash flow for a couple months, a year or 2 or whatever, and then sell the property for more later. Great when things are rising 20 or 30%, but when they're down and falling, that doesn't work anymore either. So a lot of those properties are coming to completion, getting spilled onto the resale market. And while it's still hella hard to find a proper, good single attached home, we're getting pretty swamped with supply for small one-bedroom condos. And this is going to continue to pressure prices down. It's going to continue to pressure rents down because that dynamic has changed. So it's pretty early days in that. You're probably like 3rd or 4th inning. This is kind of just getting underway. And I know this kind of sounds weird, but housing has a history of going through cycles where you just don't see a whole lot happen for a really long period of time. Prices are down 10, 15, 20% from 2022. The path back to those 2022 highs is going to be measured in years. It's not going to be measured in months or quarters, okay? And this historically is not all that uncommon. It sounds really weird coming out of that bull market for housing that we had, but that period is now behind us. And then so from a construction perspective, I guess the next take here is that, funny enough, policymakers and even the current Liberal government are pushing to double and triple supply. We were never going to get that. We're not going to get that now. Market conditions have changed to the point where we're actually going to probably see residential construction activity start to back off over the next couple years. And then the funny thing when you complete the full cycle is you come out of this 5, 6, 7 years down the road, you're probably going to be in a situation where now, again, you've had a couple years of underbuilding because the market has responded to these pretty tough conditions on the ground today. But that's for a couple years down the road. Anyway, I know so housing presentation is usually an hour itself. So if there are questions on that, we can jump back. I'll just leave you with that. So that's kind of a quick summary of everything we talked about in one slide, just where we are today and where our forecast suggests where we're going. So quick run through for economic growth. It's been soft. It's probably at risk of softening further. Inflation is a little bit on the high side, at risk of nudging a little bit higher. For interest rates, we're pretty much bang on neutral in Canada. We're probably going a little bit lower, but it's going to be not a whole lot lower, and it's going to be pretty carefully so. The equity market is one thing I didn't touch on. And this is kind of interesting because we're pretty neutral on the equity market right now. But what's funny is coming into 2025, the environment for equities was pretty much ideal, right? And you were seeing a very strong bull market. And what I mean by that is you had an environment where economic growth was strong. U.S. was growing like 2.5%, 3%. Earnings growth was accelerating. Inflation was coming down off the pandemic high. And the central bank was cutting interest rates. So you have this sweet spot where growth is accelerating, earnings are strong, inflation and rates are coming down. When you go back over time, historically, that is literally like the absolute best environment for the equity market, and that's what we had. Throw a trade war on top of it. What does a trade war do? Pulls down growth, compresses profit margins, lifts inflation, prevents the central bank from cutting rates. Takes every one of those really perfect conditions for stocks and turns them all on their head. And hence why the market really freaked out earlier this spring when this all started. Now, of course, the good news is everything's priced at the margin, right? So if we're backing off the worst case scenario, stocks are actually rallying because we priced in something that's a lot worse than what we're actually going to get. So it's this kind of awkward environment where things end up worse, but they don't end up as bad as we worried about. Stocks start to rise again, and that's about where we are. For real estate, again, just a whole lot of nothing and a pretty soft market here, especially for condos, and then Canadian dollar soft, becoming a little bit less soft as we go through this. Okay, so that is my story. If there are any questions, I don't know how you want to roll with it, but I'm happy to take them. I think there's probably a mic, or you can just raise your hand and shout them out.
Do you not think that do you not think that Canada is not driven by the commercial and residential markets? So why is the Bank of Canada so not more worried about dropping interest rates to allow us to grow? Because to me, it's cutting us growing. And they're scared they're saying, well, inflation will go up. Well, we're all paying way more for everything else, for our houses and everything else, including commercial properties. So do they not take that into consideration?
They do. So they have an explicit mandate, right? Their mandate is 2% inflation, and that's it. So if...
So food keeps going up.
Yeah.
So everything keeps going up. So you're not helping, the bank's not helping us at all. It's just basically, we're just going to keep paying. And the other day I saw on the internet that we're at the highest ever in Canada for delinquencies and mortgages. So that means that possibly all our houses could drop 40%, and there could be a lot of delinquent mortgages.
Yeah, so the delinquencies are they're less than 1%. So Canada is pretty good in that regard, I will say. So you're looking at like that housing story I was telling you about. We're not going to be making movies about this, okay? It's not like the U.S. where you're going to put the keys in the mailbox and have a wave of delinquencies. Canada is very well protected, right? So as an example, you walked into a bank in 2021 and bought that condo or that property, and you paid 1.5% mortgage rate, you qualified at 5.25%, and you were stress tested at 5.25%. The bank said, can you pay us if rates are 5.25%? And they said yes, and they gave you the mortgage, right? Now we're rolling into higher rates, but we're probably rolling into something around 3.75%, 4%. So there's a buffer in there.
Commercial properties, which we all deal with in our industry, that a lot of the clients are going to be stop spending that money on their budgets. So that doesn't help them either. And so it doesn't help our industry at all. So you're not going to see people, a lot of the clients, building commercial properties.
Yep.
So do they not take that into consideration also?
Oh, they do. So they have an explicit 2% inflation target, but when they say what do rates need to be today, they're not just looking at the inflation numbers that are published for April, right? That 1.7%. That's not what they're looking at. They're looking at a lot of the stuff we're talking about, like what's the growth forecast versus what, say, the speed limit is for the Canadian economy, right? So if the speed limit for Canada is like 2% and we're growing at 1%, the Bank of Canada is going to look at that and say, inflation might be a little bit high today, but over time we know that we're going to get downward pressure because the economy is running soft, and they'll set policy based on that, or vice versa. Right? You could have 2% inflation, but you could have the housing market absolutely ripping, and the economy growing at 3%. The bank is going to say, well, that's well above the speed limit. We're going to tighten policy a little bit because we know 6-12 months down the road inflation is going to pick up. So it's always kind of a judgment call from them, but ultimately it's 2% inflation that determines what they do. Yep.
Are there any more questions before I ask mine?
You don't have any questions. A lot of us are deal with retail, and we've all seen what's happened with Hudson's Bay, as well as many other retail chains across Canada in the last while. What do you think the forecast is for retail in Canada? I mean, a lot of our major developers are looking at their shopping centers and saying, you know, let's unload these, and especially when a lot of them are owned by pension funds. The pension funds are trying to take the risk out of real estate and dumping them. Where do you think they're going with that?
So I would say there are two sides to this. So like longer term structurally, we've kind of been, let's say, less optimistic on retail, just given changing consumer spending patterns, right? A lot of that traditional Bay type retailing is getting crowded out for either like major attraction level malls or online shopping, right? So that's not necessarily changing. So some of that storefront retail is probably at risk. That's why you always see like structurally higher cap rates in retail because of some of that risk, versus say like industrial, which was really ripping after the pandemic, stuff like that. So I don't think that changes. From a short-term perspective, we had actually started to see really positive developments for consumer spending and retail in Canada coming into the year. Like I kind of touched on this before. It was a really tough environment for consumers for a while because you had 6-8% inflation. It was running in excess of wage growth, that type of stuff. But the last 6-12 months, wage growth is still firm. Inflation has fallen off. Real like inflation adjusted disposable income in Canada was actually starting to grow again. So a lot of the negatives around like mortgage resets and that type of thing were probably a little bit overblown. Wasn't an environment where consumer spending was going to rip, but it was going to hold in pretty well. And so the concern now would be that if we actually get outright job loss, which is a legitimate risk if this trade war plays out, then that kind of changes everything, right? Rising jobless rates and job loss changes everything. We don't see that yet, but that would be a risk. So short answer is I'm not bullish on retail per se, if you want to distill it down to that. In the scope of commercial real estate, I would probably put it down in like the bottom third.
I get most of my news from the internet, so you can probably tell me in your answer that I'm all over the map and wrong. My understanding is when Carney first got in as the leader and therefore the prime minister, he bought a lot of U.S. debt and got Europe to sort of buy into the same idea. We already know China has owns a lot of U.S. debt. What's the real implications for the States by having all that debt owned by foreign countries? I mean, what's going to happen in the worst case scenario?
Well, it's one of the powerful weapons that countries like China and Asia and the rest of the developed world have against the U.S. is that the U.S. borrows a lot externally, and a lot of that's held in reserves at foreign central banks or foreign funds, right? Like China. And what you've actually seen is incrementally, not necessarily outright selling of treasuries in response to this, but even just incrementally less buying. What does that do? Like, it just quickly puts upward pressure on U.S. borrowing costs, right? So a country like China can say, well, you're going to put a tariff of 125%, 145% on us. Well, we'll just direct some of our securities holdings elsewhere. And the response, the retaliation is higher borrowing costs in the U.S. 30-year yields, highest since 2008, right? So some of that is happening already. And the U.S. is making it a pretty easy decision by running a budget like they're running right now too. It makes it pretty easy for foreign investors to look elsewhere. So it's a legitimate threat. And I mean, the simple answer is you can crank up U.S. borrowing costs and tip them into recession in response to them putting tariffs on. It would be extreme, but that's where we could go.
What are your thoughts on the recent Ontario budget that was tabled, and in terms of their commitment to continue spending, increase deficits without nothing in sight in terms of reducing our deficits in Ontario? What are your thoughts on that in terms of, is that exacerbating our problems? Is it the only solution available to the Ontario government currently?
Yeah, so I'll say this to start. So I didn't love it. I know, to your question, but I'll say this to start. Ontario was actually in a great spot. So I talked about Canada being in a good spot, and I'll honestly say that Ontario, the last 3 or 4 years, was making a lot of progress against the rest of the provinces too, from a fiscal perspective. I would say they were probably almost right at, excluding like in Alberta or Saskatchewan that is oil, they were probably right at the top of the pack. There are others like British Columbia that were completely blowing out the budget when times were good, losing credit ratings and all of that. Ontario was not doing that. So yeah, like going back into deficit's a tough one because you have to budget a tougher economic outlook, which hurts. And then you can make a choice. Do I pull back spending to keep the budget balanced, or do I just let it run to support the economy? And they decided to let it run. You can probably argue that there was maybe a bit more like program spending in there that's not going to do a whole lot to stimulate growth. Maybe they could have cut taxes more or something like that, or ran infrastructure. But they were doing that anyway too. So I mean, from a fiscal perspective, I'm still actually pretty positive on Ontario. They have a really good habit of setting the bar here to start the fiscal year and then coming in here. And I'm almost sure they'll do that again.
Robert, do you see the U.S. administration becoming a bit more stable now we're sort of past the initial part of the tariff war? Is that something we're going to deal with forever?
Stable? Oh, if I could
more
wish.
more stable than what we've seen, because obviously the instability is what upsets the markets.
Yeah, I don't think so, unfortunately. I would say that they've probably been taught a few lessons early on that what they're doing is actually really bad economic policy. Like between us, it makes no fundamental sense. And they've walked some of that back, partly not only the response that they've got from other countries, but responses from the industry within the U.S. itself, whether it's steel, aluminum, or autos. They've walked into the White House and said, guys, what the hell are you doing, right? So there's some of that, but stability, no. And I think the big risk is that even if we end up in an outcome that's okay, like we talked about earlier, who's going to go and hire and like deploy capital in the next 2 years when you don't know if the rules of the game are going to look different tomorrow morning? So I think the damage is in a lot of ways already done on that front.
So when we get rid of Trump, do you think things will bounce back, or are we all learned that Yeah.
Well-
Will it be that people will say, you know what, we've just realized how dependent we are on the States and how much it can hurt us, so we're going to change fundamentally forever?
Yeah. So couple targets, I would say. USMCA is up in 2026. We're probably going to get a deal inked there. The question is anybody going to believe it, right? We have a USMCA deal right now that was kind of disregarded. So that would be the first step. We're going to get something. Are we going to believe it and see investment? I don't know that part. 2 years, we'll get to the midterms. Presumably, they'll lose the Senate or the House or both. But most of what we've actually seen pushed through was under executive order by the president. So that probably doesn't give us the total cover that we need either. And then after that, we're looking at 4 years. So unfortunately, again, like, key point here is we're probably past the worst. We're probably going to end up in an outcome that's not terrible, but who's going to want to go there and behave normally when you don't know what the rules are going to be?
Hi, I may have missed this. You may have covered this earlier, but I was wondering about opening the borders between the provinces and this idea of, easy flowing trade, so on and so forth. How will that help our economy, federally, but also provincially? Or is this, all talk and no action kind of proposal?
Well, so it's kind of both, right? We have provincial trade barriers that are kind of ridiculous when you think about it, right? Even we have a Canada Free Trade Act with like hundreds of exemptions in there. And it's kind of ridiculous. There's so many anecdotes, like pick one. It's like, okay, I can't buy BC wine here in Ontario. Or if you're driving a truck across one of the provincial borders, it's like I have to stop here because I can't drive in the daytime across the other side of the border, like stupid stuff like that. That's easy, right? We're going to clean that out, and I think we will. Carney and like as I mentioned, Carney and the New Liberals, love them or hate them, have a much more like pro-growth agenda than the last Liberal government. So they're going to clean that out quickly. I think they will. I would also say the economic impact's kind of been overstated. Like there's some academic work out there that's said if you eliminate all these barriers, it's going to add like 2 points to Canadian economic growth, like 2% to the economy. It's probably not. But there are aspects that totally make sense. So you're probably in an industry, and we speak to industries a lot, where you have skilled workers trying to move across borders provincially, and they can't because of, well, they can, but it just takes a lot of time because of all the paperwork and all the other regulatory stuff they have to go through. Just strip all of that out and just go to like the lowest common denominator almost, in a sense, and overnight you can add productivity growth for free. So we're going to do it. We should do it. It's free economic productivity growth, but it's not going to offset a trade war with the U.S., no.